Welcome to the weekly update, where I'll go over the action in the market for September 29th through October 3rd, and we'll see how things look for the week of October 6th through the 10th. Okay, had an up week. Now, the government is shut down, but that doesn't seem to be having much of an impact on the markets. Under the surface of these upward moves is a market that's pretty convinced that the Fed's going to cut rates, but not because economic reports are falling apart. We saw that a week ago, and that started to creep in some fear that maybe the Fed won't be able to cut rates. But then the employment report, which didn't come out, the weekly jobless claims, which didn't come out, that didn't help anything. But the other economic reports that were received were weaker than expected. So now the market's a little bit more happy, thinking that, okay, they might come in and cut rates after all. It's not because the economy's falling apart. It is just to tweak it a little bit. And the market is anticipating that there will not be a recession. That's when earnings really fall apart. And earnings are still looking pretty solid. That's ultimately what drives stock prices. Companies earn money, their stock goes up. Companies lose money, their stock goes down. Okay, so let's go back and talk about the week of September 29th through the 3rd of October. For the week, we were up 1.09%. Not really strong, but still an up week nonetheless. We were above average with volume. Now, since the government is shut down, we've been dropping on the daily charts down below average with volume because the market likes to key off of these things and just kind of say, okay, what's going to happen? We've got so many things going on in the world right now that don't have an impact on the market, but that could change. Things in the Middle East, things between Russia, Ukraine, all these domestic things going on in the US. And the market's like, okay, we need a little bit more information before we're willing to commit to buying more stocks or selling for that matter, because we still have this positive backdrop underneath the surface. So we are positive on the technicals. I'll go through the charts. There's always some things to be concerned about, to keep an eye on. And interest rates, they're coming back down. Now, they went up on Friday, but we have been coming back down again with the 10-year yield, which has been helping stocks to maintain their gains. The market's really not concerned about inflation right now. Of course, lots of geopolitical concerns. Now, we're going to be starting to head into earnings season, and that over the last couple of years has typically been positive. But be careful. Tesla had this happen this past week. They reported earnings. The stock really ran up into that, and then they came out with their report, which was very good. But then looking forward, it's like, well, these tax credits that people are getting for buying EVs, well, they're going to go away, and that might hurt us. And the stock really went down on that. So there was some news that actually came out with the earnings. A lot of times what we'll see is by the rumor, by the lead up into the earnings report, and then maybe some selling when the report comes out, even if it's looking good with the report itself or looking forward. And so companies are going to start entering a blackout period, which if you don't have a lot of these companies coming in there and buying their own stock, especially with the really big companies, that doesn't have that support that we usually see. And as far as the recession, market doesn't really think that. We did get some Fed speak, but it's all over the place. Some are more hawkish, some are more dovish. If you were to take it all together, the Fed is typically more dovish right now. Now, they should release the meeting minutes in the upcoming week on Wednesday at 2 p.m. Eastern time. So we'll get some insight as to what the Fed was actually thinking there. Now, as far as our trend, we are finally strengthening, and this is long term. This is the weekly chart. We're seeing the beginning of a new strengthening trend that's positive on the daily side, both with the short and intermediate term chart. Now, we're not trending it. It's not a confirmed trend on the weekly side, but we're crossing back above the moving average, which does show a strengthening trend. It's not confirmed until we go back above 20, and I'll show you that chart there. But it's positive. So all three time frames continue to be positive. So looking at the week, the Dow was up 1.1%, and the NASDAQ up 1.3%. The S&P up, we rounded it up here, 1.1%. It was actually 1.09%. And the small caps are doing pretty good. The lagging index right now continues to be the mid caps, but small caps were up 1.7%. So, just some bullet points here. The major averages advanced further into record territory. We did set all-time highs with the S&P, not with the NASDAQ and NASDAQ 100 on Friday. They set those earlier in the week, but they were down on Friday. But the Dow, the S&P, setting all-time highs just barely on Friday. We were virtually unchanged with just a few points positive and less than 0.1% higher there. And the market's now shrugging off the ongoing government shutdown, at least to this point. We'll see how it's not looking real hopeful as I looked at the headlines before I started recording. This would be Saturday evening U.S. time. There's really no answer to that right now. It's looking like the government may remain shut down. Of course, and there's all this misinformation going back and forth, no matter what side you're on, that this is what they're trying to do, and the other side said, no, this is what you're trying to do, and they're pointing fingers at each other, and they're making claims, each side on the other side. It's politics. That's how that works. And so for right now, stocks are still looking pretty positive, which could allow for further gains. Economic data that we did get was mixed, but reinforced the dovish Fed expectations, meaning that the economy is slowing down a bit, but not falling apart. They're likely to come in and cut rates and hopefully boost that back up. And the healthcare sector. Now, it's still not looking all that good in the bigger picture, but it was pretty strong. There was this exchange, pharmaceutical exchange, they're calling it Trump RX here. And that was announced, and that gave a lot of support to the healthcare sector. It was up 6.8%. And then tech was up 2.3%. Nvidia's setting all-time highs. It was down a bit on Friday, some profit taking there. And then Tesla's earnings were not well received. I already talked about that one. Utilities were up 2.4%. Now, again, and I say this quite often in these videos, typically utilities are a value or defensive area. It's what you put widows and orphans in because everybody needs utilities and they typically will pay dividends and they're usually the boring stocks that nobody likes. Well, with AI and crypto mining and all of the laws that were being changed, it's like, okay, we're going to need an awful lot of electricity. I saw one headline that one AI farm uses more power than like New York and Boston together or something. I don't know if that's true or not, but somebody sits down and cranks this stuff out, but it's a lot of electricity. And so instead of this being a defensive, boring area, it could also be considered a growth area in the market because there is this massive need for utilities, electricity in particular. And then energy did decline. It was going up there for a while. We're getting down to the 60 range with oil because OPEC Plus, they came out and made an announcement saying that, okay, we're going to lower we're going to up our production expectations. That puts more on the market. There's more supply out there, and that pushes the price down. Okay, and then the market's resilience, and it really has been. We haven't seen any kind of a significant pullback, and we're watching the 20 period moving averages. And even when we have a down day or we're down intraday, we're not even close to the 20 period moving average. We will still be watching that because at some point the market's going to make a more substantial decline. And is it going to be Monday? Is it going to be this week? Or are we just going to continue to chop higher? Because it's been frustrating because even when we go up, we're not getting an awful lot of confirmation that there's really a lot of strength in the market. It's not turning weak, but we're not seeing this robust strength in some of our internal indicators. So you combine that, setting record highs, which are positive in and of themselves, dovish Fed expectations. This is reinforcing the confidence that additional easing could provide further tailwinds for equities heading into earnings season. Okay, so here's that little statement there. Now, we're still okay as far as inflation. Now, we think we had CPI a while back now. We'll see if some of these reports get delayed, but we're still in the lower range. We're not down to the 2% level where the Fed wants to get. That was with the core PCE a week ago, but we're under that 3% level. Not by much, but we are under that. So this light blue line here, we're still pretty much within that range. We go up a little bit, then down a little bit. But I show this chart because things can change. And this is when we saw a period of just massive inflation with no growth, which a new term was coined during the mid to late 70s called stagflation. All right, so let's go back over the session here too, where we're down to 4.12% with the 10-year yield. It's coming down. We were at 4.19%, and then we've been dropping a little bit from there. Now, a week before last, we did try to test the 4% level a couple of times, and then we started bouncing up. Now we appear to be coming back down, but we're still above that 4.02% level. Earnings are still looking pretty good, but if we can get back below 4.02% and then stay there, that could actually help things quite a bit as well. All right, and I don't have any employment data to show you because we didn't get the report in Friday's session. So this chart has not been updated, nor has this chart. FactSet did have one post with 3 different charts because they're getting geared up to go into earnings season. It says the earnings per share estimates for the S&P 500 companies, they've increased. Okay, so we're seeing the numbers actually going up when you look at these different charts. So that's showing some improvement. All right, here's the intraday chart. It's positive because we ended up with a positive week where you can see not an awful lot of conviction here. Monday, Tuesday, very choppy. We did see a nice lot of buying going into the close on Tuesday, and that's more encouraging. This is the smart money coming in and seeing strength going into the close. And then we were pretty good on Wednesday. We were able to hold on to those gains. And we gapped higher on Thursday, came down and closed off of the high, but also off of the low. And then we started to go up. We hit the 67.50 level here. We didn't quite get up to R2 on Friday, and that's pretty much where we topped out. Then we saw some selling later on, and we closed pretty much unchanged on the day, just barely positive. All right, so this is just looking at the different indexes for the week. They were all up. And this is just the 5 trading days, not Friday to Friday. It's Monday through Friday, but everything was up with the small caps kind of leading the way higher and the NYSE. That's the broad market, and that's looking pretty good as well. Where we had the NASDAQ, it was up, but it was up less. And then, excuse me, the NASDAQ 100, and then the NASDAQ was also up. So the areas, the 3 big indexes, the NASDAQ, NASDAQ 100, and S&P, they were up, but they underperformed this week, just during the 5 trading days. But we go back to the beginning of the year, we still have the NASDAQ and NASDAQ 100 and S&P leading the way in the longer term. Sectors, we were up, where you can see healthcare really up solid, up over almost 7% on a percentage basis, but not looking all that good with its scooter score. It's got a lot of damage there. We also saw utilities doing quite well. Then tech did okay, didn't really carry through and really lead things higher, but it did have some good days. And then energy ended up being down, where a week ago it was the best performing sector. Then you have communication, that's a growth area. It ended up being down. And so there was not an awful lot of conviction here. And then looking at the scooter score, we still have the tech sector looking the best at 93, and that's pretty solid. And then quite a distant second now is the communication sector, another growth area at 72.5. And then discretionary down here, not great, but still okay at 62.5 there. These are the big areas that we really want to see doing well, and they're doing okay, but they're not showing an awful lot of conviction right now. And then staples, this is also positive because staples are what the market loads up on when it's getting ready to go down. It's coming in with a score of 2.1, and that's not very good. All right, so just the 5 trading days for the different sectors. Healthcare was clearly the leader, but the area's been so beaten down, and it's really underperforming the S&P quite a bit. And watch the intermarket analysis video to show I compare the sectors. Not only we look at them individually, but then we compare them to the S&P to see how they're performing. Then utilities were up and tech was up. We had industrials just barely up. Where communication, another growth area, that ended up being down during the 5 trading days, as well as was discretionary. And a lot of that's probably Tesla getting hammered when they reported earnings. So going back to the beginning of the year, tech, communication, those are 2 big growth areas. We would like discretionary to do better, and it's still doing okay. It's been improving. If you go back into August or so, and then through September, the discretionary to staples ratio is still looking about the best right now. So we'll see if that can continue to catch up. And then we have utilities. I'm sorry, staples down here, not really performing all that well. So here's the carpet for the whole week, where we did have tech up, Nvidia setting new all-time highs there. Microsoft and Apple were up slightly. Oracle was up a little bit there, less than 1%. But the two Google stocks ended up being down. Meta was down. See, these are communication areas. A lot of red here. That's why it didn't perform as well. And then discretionary, we had Tesla down, Amazon down a little bit, the two big stocks there. But then healthcare, a lot of green in here. We'll see if there's more carry through with that. All right, then the relative rotation graph. We have the discretionary, it is doing okay. It's rolling over a little bit. We want these to go up and to the right. That's when they're showing some strength. And it's still kind of doing that, but it's slowing down. What we're seeing is communication over the last year is still looking pretty strong, where we're seeing a bit of a drop off here with tech, and then a bit of an improvement here with healthcare. And a lot of that's just been lately that we've been seeing. It's actually blue and moving up and to the right. It would be even more positive if it could get way over here to this green square. But then a lot of these are improving, but they're still negative overall with the sectors. So we have discretionary and communication still looking more positive. Tech is a little more neutral, but still looking okay. A lot of sectors are still negative, with healthcare showing some improvement there. You know, looking at the indexes, we still have the S&P kind of camping out right around the midpoint because it's a balance between growth and value. We have the OEX still improving. That's the S&P 100, and that's good. But we are seeing a bit of a tapering off here with the NASDAQ 100 as well. And then small caps are still showing some improvement and starting to come on, where we're seeing a real move down here with some of these other areas. The mid caps were improving. Now they're coming back. The Dow Jones Composite, it's looking, actually, it's coming down and trying to turn back up. Utilities are seeing a little bit of a turn up here, but the transports are just not doing all that well. So we have the S&P 100 looking more positive, where more neutral is the NASDAQ 100 showing some recent weakness, then the other negative areas with the small caps showing some improvement. Now, sentiment. We did get a reading. This was back on October 1st, so this was Wednesday, midweek, where the investors' intelligence, they're above this 3 level now. And that's when we start to pay more attention to this. Now, it could go higher than where it's at right now, but this is when we start to look a little extreme here. It's like they're making too many positive recommendations. We use this as a contrarian indicator once we get above this 3 level. But again, it could go up even more. So we don't want to use a contrarian right now. We want to wait to see if this is actually starting to come down. And then this is actually probably what's helping the market. You got a lot of people that don't believe the market should be going up right now. So the fear and greed index, we're still neutral, tilting a little bit towards the positive side. But if you look at the chart here, we were actually coming down with sentiment, getting down to that 50 level. So overall, we have been declining with sentiment as the market's been going up. And that could mean that there's more room to run to the upside before we get too exuberant with that. Active asset managers also holding on fairly positive here, but still below this red line. Not too overly exuberant here, coming in with the score of 80.66. And then the VIX, it is going up a little bit here, but we're not seeing an awful lot of fear coming back into the market. Both with the line chart, and that's a weekly, we are coming back up. We had been declining with the bar chart overall, where we're starting to go back up. But we're still below 20 with both of these charts, and we just have not seen any real negative seasonality so far develop. We were looking for it halfway through July, didn't happen. August didn't happen. September didn't happen. And so far in October, it hasn't happened either. And we're still looking positive here. When this black line's going down, that means the tech sector is outperforming cash, and that's positive. And a little more bearish here with the RIDEX bear bull ratio, but typically they've been more positive. But these are folks too. They use RIDEX mutual funds, and again, they tend to react to what's already happened, and they're getting a little more fearful. If the market could continue to go up, then they're going to be afraid of being left behind. And then that's when we would see this ratio really dropping down here. And if it stays down here for a while, that could also line up with the other sentiment gauge as folks are afraid of missing out on some gains. And not much of a change here with the individual investors in the latest survey, just barely looking bullish here. That also suggests there could be more room to run to the upside. So here's another little breakout here with the bullish sentiment in blue, a little bit above the bear sentiment, which is in red. This is the spread that I showed in the previous chart, just barely above the zero level. And then we have a 2 month moving average here, which is still showing more bearish. The red is still above the white line here. Ulcer index still giving us a very low reading. Not really seeing any changes here with the spread between risky and not as risky bonds. That's positive. And coming down a little bit here, but still giving us pretty high readings overall, showing there's not a lot of fear in the bond market. I showed this a week ago, but we haven't really changed all that much. We're still getting to very low readings. This is that same spread between risky and not as risky bonds. And now this is interesting to watch here because as we've been going up out of the April lows here, we've been coming down with the VIX to 3 month average of the VIX ratio. You see how we're starting to tick up just a little bit here? That's some fear coming back into the market that we're really not picking up all that much with the VIX. Now, it hiccuped before and then continued to go down, but we just want to keep an eye on this one. But this is longer term, but we're still declining with the long-term equity put call ratio moving average here, 253 periods. This is still looking positive longer term. And now, okay, we didn't really get any reports, but we didn't really see much of a change with the weekly economic index. The Chicago National Conditions Index still below the black line. That's positive. And then the Atlanta Fed GDP now still coming in just a little bit under 4%. GDP is looking pretty strong without inflation really going up all that much. And this is showing good growth in the economy. So this is showing how GDP is continuing to improve when we look at the GDP now this way. Then the New York Fed staff, they're actually going up with their predictions of GDP as well. And this is one, I think I showed this a week ago, but this just shows how we've been going up for the most part. It breaks it down a little bit, but this was the fourth quarter of 2024. Then we had the first quarter of 2025, and now how GDP has been improving since then. And we didn't get an update with this. This updates when the employment report comes out, but this chart was updated. It comes out earlier in the week. We are going up here, but we're still below this black line when we look at the smooth U.S. recession probabilities. So it is going up, but not at the real danger area, at least yet. This wasn't updated either. And then now we have a new quarter that we're starting since we rolled over into October. So not much of a real change here. We have been drifting down a little bit with the inflation now casting. And there's a 96.2% chance that when the Fed meets on October 29th, we will be at 3.75% and 4%. We're at 4 to 4.25% now. They've already cut 25 basis points. The market thinks that they're going to cut it again, another 25 basis points at that meeting. And the market's getting a little bit more convinced of that. The dark blue, that's the current reading. Then we have a day ago, a week ago, a month ago. And that seems to be the going conventional wisdom right now. Then we start looking out to the December 10th meeting, 86% chance that they're going to be cut again after that, another 25 basis point cut. And the market's becoming a little bit more convinced that that is what's going to happen. And here's the Fed balance sheet, which continues to go down, and we still continue to go up on a year-over-year basis. And not seeing anything all that crazy here with the overnight reverse repurchase agreements. Okay, so now we're looking pretty good here. It's kind of hard to tell, but we are setting a new all-time high with the advanced decline line based on price. A little more of a conviction here based on volume, and that's what we've been seeing on the daily side. We're seeing volume outperforming price, and that could be positive given the context of what the market's been doing lately. We're not seeing a lot of upward thrust with price. I mean, we're setting all-time highs, but not by huge percentage amounts. But we are seeing steady increases in volume here that's looking more positive. And we are seeing more highs than new lows, so we're starting to go back up with the 4-week chart and the 10-week chart. We're going up above zero with the short and intermediate term advanced decline ratio. And this is where we're starting to see a longer term strengthening trend. We're turning back up now. We crossed above the moving average with the ADX, and the green line is above the red line. This won't be a confirmed trend until we actually cross above 20. Now, that's a static number. I don't always like to use static numbers, but this is kind of what you have to do with the ADX. That's why I put the moving average on here because it's more dynamic. It changes with what's more actually happening instead of just looking at the 20 level all by itself. Still looking good with the Arun, maybe getting a little extreme. A lot more buyers than sellers. That's why the oscillator is giving such a positive reading. No signal being generated by the mass index. Okay, then we look at the daily chart. Still looking pretty good. Higher highs, higher lows, setting recent all-time highs here. Once we got out of September, we broke above this overhead resistance level. The market was having a hard time getting above. Now we're above that right now. We are in an uptrend with the blue line above the red line, although we've been dropping off to below average with volume since the government decided to shut down. But still looking good here. The weekly chart of the S&P with the 50 period or 50 week simple moving average. Price is above the line. The red line's going up, looking pretty positive. Moving average crossover, looking pretty good, setting all-time highs there. And we are still looking good. These are weekly bars here, and this is still looking quite constructive. Higher highs, higher lows. We're above this R1 point. Now, if we really start to tank, we're going to be watching this as support. But this is 64.68, and we closed at 67.16 on Friday. So we're going to have a pretty substantial decline just to get back down to that area. And still looking okay here. We're breaking out of the upper end of this trend line going back to 2009. And now the weekly charts are looking pretty positive with the smart money indicators. We're seeing a little bit of a mixed picture after Friday with the daily side here. But the accumulation distribution above the advancing moving average, longer term positive. We are positive with the boom indicator, but we are above this red line. So that could be suggesting we're getting a little extended. And we're rolling over though a bit here with the chicken money flow, and we're negative on the daily side as well. We're seeing a dropping off here of the histogram, which is causing the red line to go down. And then the McClellan oscillator is above zero and going up. And so now we're starting to go up above zero with the summation index based on price. And you can see there's more dots here with the volume. That continues to show that volume is outperforming price. But price is the ultimate indicator, so we have to go with that. You don't want to buy a stock and say, well, it's not going up, but volume's doing well. I'm making money. No, you're not. But we just use volume for clues. Look at price as the head. Look at volume as the neck. You can turn the neck left or right. And I got that analogy from that movie, My Big Fat Greek Wedding. And doing okay here with the bullish percent index. It's going up, but we're setting all-time highs and we're just kind of meandering around with the bullish percent index overall. Now we're getting extreme here. Now we did get extreme on the daily side, and now we're starting to come back down, and we've turned negative there. We're above this red line. We're still above the moving average, giving us a very high reading right now, but it doesn't necessarily mean a reversal. But it might mean that we slow down. It could mean that we're going to see more of a substantial pullback. But if you look at other times here, when we hit this really extreme reading, it didn't necessarily mean that we stopped. We might have drifted down a little bit. That's why, based on what we're seeing right now and what we have been seeing for the last couple of months, is if we do get some kind of a sustained decline, that's all it's looking like right now. It's not like the overall character of the market is going to be shifting from positive to negative, no matter what the perma bears say. Now, we'll evaluate that if that starts to actually play out and see if the characteristics do start to change. But we're getting very high readings here with the vortex. The green line is above this black line here, not quite up to the red line, but we're getting a really extreme negative reading with the sell signal with the vortex. But this is looking quite positive. And then we look at the Swinland trading oscillator. We're above zero based on price and going up. We're also above zero based on volume. And we're still going up with the PMO. We're back above zero based on price. We're back above the moving average as well. See how volume is slightly outperforming price here. And we're above 50 and going up with the PMOs that are rising. We're barely above 50 with the buy signals. After declining, we're trying to go back up here with the PMOs that are above zero. Bollinger Band still looking solid. We're above the midpoint, but we're not above this blue line because we've been able to maintain price inside of the Bollinger Bands. So we're still going down with the slope oscillator, but we're going up with the TSI. And we're seeing that not like this here, But we are negative on the daily side with the slope oscillator, where we're positive with the true strength index or TSI. These are the two short-term oscillators, and they're contradicting each other here, and they're contradicting each other on the daily side, where we are looking more positive in the intermediate term, but look how extreme we're getting with the MACD. Not quite extreme here with the PMO, but still positive with the PPO, and not keep an eye on the MACD. That's a very popular momentum oscillator. And we're positive here with the tricks and KST, possibly starting to look a little extreme here with the long-term oscillators. And we're negative with the copy curve. We're also negative on the daily side. Positive with the force index. And starting to get extreme here with the money flow, but that's positive. And showing longer term momentum here with the Stochk RSI, the Williams percent R, the RSI based on 14 weeks, we're starting to break above 70. So we're looking a little extreme, but this could still go up more than where it's at right now. And coming down, but still extreme with the ultimate oscillator. And we had an up week, so we're above the midpoint with the rate of change. Still hanging out around this red line here with the 50-week rate of change chart. Positive with the weekly special K chart. And I didn't adjust this because we set another new high here. So if we do set a high and start to come down, I'll readjust these Fibonacci retracement levels. But on a trending basis, the Heikin Ashi is looking good, as is the Kagi chart, the Renko chart, and the three-line break chart. We did have a couple of new X's drawn in here on the point and figure chart. Double top breakout back on June 2nd. That's still intact, and we're going up longer term. And we're still looking positive here with the ease of movement going back 14 weeks. So the long-term momentum is positive. We're leveling off with the intermediate term, and we were declining, but starting to flatten out with the short-term momentum. All right, and we're still neutral though with the Elder's impulse system. We're still positive with the parabolic SAR. Positive. Now this is based on daily charts here. Positive on all time frames across all the different indexes that we follow. The dollar continues to be negative, and that's where a lot of the strength has been coming from. As the dollar goes down, it's been helping not only stocks but bonds and gold and silver to also go up. So we're setting highs here with the S&P. We still haven't come back to the recent highs with the mid caps or small caps. The Dow setting an all-time high here, up over 1% on the week in an uptrend. NASDAQ setting recent all-time highs in an uptrend. NASDAQ 100 recent all-time highs in an uptrend. Mid caps in an uptrend, but again, not getting back to these previous highs at least yet. Now, this is the S&P 400 mid caps. Now, most people follow the Russell 2000 small cap index, which I follow on the daily side, but this chart here is the S&P 600 small cap index, where it has not set a new all-time high, but it is in an uptrend. The NYSE looking pretty solid here, setting new all-time highs. All stocks looking pretty good, which is a mix between US and international stocks. The FANG index did not set a recent all-time high here, but it's still looking pretty solid. ARC is looking pretty good these days as well. And now we're over into October. You go back to 2021, we've been up 60% of the time with a return of 2.4%. And the banks looking a little bit better here, even though they didn't have a really good week this week. We had gotten above 70 with the RSI, and now we're pulling back here. We're still positive, but rolling over a bit with the weekly chart of the momentum using a MACD. So we have the Dow setting an all-time high, but this is a Dow theory non-confirmation. That's not being confirmed by the transports, but we are seeing the utilities coming on strong and setting new all-time highs here. Then we look at commodities, just kind of moseying along sideways, not really showing an awful lot of conviction there. We did get down into the 60 range with oil. Copper's looking good here. We are in an uptrend, and that's a barometer for the economy, where we're in a downtrend here with the weekly chart of the US dollar, setting new highs here with the gold ETF and silver ETF. And total bonds still looking good based on price. And then the stock to bond ratio monthly chart, we rolled over at the end of September. Now we're starting to calculate for October, still showing how stocks are outperforming bonds. And we have been coming down here with the 10-year yield. The Fed cuts rates. We started to go back up. But for the most part, we've been trying to come back down here with these yields. And we're still watching this Japanese red line here. That's the 10-year in Japan. That continues to go up there, but so far hasn't really caused any problems. So we have gold, my goodness, up let's see, up over 48.5%, 48.63%. Massively. So why is gold going up? Is it because of all the insanity in the world right now? Probably. But stocks are hanging in there pretty good too. They're in second place right now, where we have commodities and bonds. They're pretty much neck and neck. Oil is negative, where a week ago it was positive. And the dollar just continues to trail along the bottom as the worst performing asset so far year to date. Then we look at some ratios here, and this is still looking pretty positive. NASDAQ 100 to S&P looking pretty solid there. S&P 100 pulling back a little bit, but in the bigger picture, still outperforming the S&P 500. Growth is still outperforming value, but we have been seeing this coming down as the market may be trying to get a little more defensive in case we do decline. And gold is outperforming the S&P, even though the S&P is setting all-time highs. Gold's been going up even more, and the dollar's been going down, gold's been going up. So this ratio is back to shooting for the moon. Still seeing how longer term bonds are underperforming stocks. Bonds based on price here. And low volatility still going down here to the S&P. That just means the market is not becoming more defensive. Discretionary to staples, we are going up. We were down a little bit on the week, but this ratio is still looking pretty solid here. And energy is dropping down and really underperforming the tech sector. Small caps, even though they had a good week, they're still underperforming the tech sector longer term. Then, not really seeing much of a change here with the NYSE Breadth Thrust or the ZWAG NYSE Breadth Thrust. We're still working off of this thrust signal that was generated back in April, and that is looking good moving forward. And still at a -6 with the Zohar-Check method. That has not changed. Still looking good here with the NASDAQ weekly chart above the trend line going back to 2009. Now, a week ago, I was pointing this out. We're just kind of chopping along sideways. This is long term. 50-week moving average of the new highs, new lows for the S&P. Now we're starting to break out a little bit. So that's turning more positive. And we actually declined after we were seeing more conviction here with the NYSE new highs, new lows, 50-period moving average. But it went up on the week, but it's kind of stalling a little bit right now. The Qs to small caps still looking really good here. NASDAQ 100 to Dow ratio still looking really good there. We're still declining with the 3-month yield. That's also been helping stocks as shorter term interest rates are coming down. And we're still looking pretty good here with the new highs, new lows cumulative measurement here for the NASDAQ. Seasonally, we are in the third best performing half a month now that we're in the first half of October. Second half of October is still positive, but not one of the better performing times. And October also, going back to 1964, we're up 59% of the time with a return of 1%. Then we take the whole period, June through November, which of course includes October. We're up 3.4%, a little bit over 2/3 of the time. And this looks pretty good here with post-election years for the S&P going back to 1950. We're up 11 out of 18 times, down 7 out of 18 times with a return of 1.3%. This is a newer chart here that no matter how you slice and dice this, we look positive for October, according to Carson. If you take all the years, that's the yellow area, that's positive. If you just look at the past 20 years, that's still looking positive. The past 10 years has been when we've seen most of the strength. And then if it's just post-election years, that also looks pretty strong. So we have some positive statistics there in October. And then this also, we're outperforming all of these lines. These are Stock Traders Almanac lines here, and we continue to be above them. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.